Corporate bonds, like any investment, offer a trade-off between risk and reward. The strongest issuers tend to pay the lowest coupons. Higher coupons are offered by smaller or less secure issuers. Bonds have some advantages over shares. Their prices tend to be less volatile and they require less day-to-day investor oversight. The payment is usually a fixed amount, while a share dividend is not. Many bonds have fixed due dates, while shares do not. Bonds, though, do not offer the same upside participation in good corporate news as shares do. The key risk with a bond is the chance of a company being unable to pay a coupon or repay the bond. Failure to meet bond obligations is more serious for a firm than failure to pay a dividend. Generally speaking, if a company collapses, ordinary shareholders may lose their entire investment. That is rarely so for all bondholders. The more senior bonds are paid before the junior or subordinated bonds, and of course before any payments to ordinary shareholders. When choosing a bond, therefore, it is important to know where the bond stands in the event of insolvency. The least secure bonds in a given entity tend to offer the highest coupon in recognition of the additional degree of risk. Finally, one subtle long-term risk. Bonds are particularly sensitive to inflation because they are priced in nominal terms. Shares, by contrast, being an ownership slice of a real asset, tend to be less affected. Those fears of higher inflation are usually heralded by higher interest rates, which can have an immediate negative effect on bond prices. The value of investments can fall as well as rise, and any income from them is not guaranteed. You should be prepared to lose your investment. Past performance is not a guide to future performance. When buying gilts and/or bonds, you should consider the issuer's credit rating and their ability to repay their debt. This will have a direct bearing on the value of the investment. Should the issuer default, they may not make interest payments or be able to repay your money.